There is a strange contradiction hiding inside the American financial system. Imagine two people. The first has never missed a payment. They avoid debt whenever possible, pay for almost everything with cash or a debit card, and believe that staying away from credit is the safest financial choice. The second person has several credit cards. They use borrowed money almost every day. They owe thousands of dollars at different times throughout the year. Yet banks compete to offer them lower interest rates, higher credit limits, and better rewards. At first glance, that doesn't seem to make sense. Shouldn't the person who avoids debt be considered less risky? For millions of Americans, the answer is surprisingly no. Because the biggest misunderstanding about credit scores is believing they're simply a measure of how responsible you are with money. In reality, a credit score is designed to predict something much more specific. How likely are you to repay borrowed money? Based on your past behavior within the credit system? And that difference changes everything. The loophole isn't about tricking the system. It isn't about finding a secret button that instantly raises your score. It's about understanding how the system actually works, instead of how most people assume it works. What many people call a credit score loophole is really a misunderstanding that has existed for decades. People think they're being rewarded for avoiding debt. The system is actually rewarding something else: predictability. From the perspective of a lender, uncertainty is expensive. Every loan carries risk. Every credit card application is a prediction about the future. The question isn't whether you're a good person. It isn't whether you work hard. It isn't even whether you're wealthy. The question is much simpler. Based on everything we've seen before, how likely are you to pay us back? That's the problem a credit score is trying to solve. Now imagine two applicants walk into the same bank. The first person has earned a steady income for years. They've never taken out a credit card. They've never financed a car. They've never had a personal loan. They've paid for everything in cash. The second applicant earns about the same income, but they've used credit cards responsibly for years. They've made payments consistently. They've kept older accounts open. They've shown a long history of managing borrowed money. Who looks safer? Most people instinctively choose the first person. After all, they avoided debt altogether. But many credit scoring models see something different. The second applicant has a much longer track record, not necessarily of having more money, but of demonstrating how they handle credit over time. That's a crucial distinction. A credit score doesn't reward avoiding the system. It rewards providing enough information for the system to evaluate you. And that explains why so many people are shocked when they apply for a mortgage, a car loan, or even a rental apartment. They've done what they believed was financially responsible, yet they're told they have a thin credit file. In other words, there isn't enough history to confidently predict how they'll manage future debt. For many people, that feels unfair. And in some ways, it does seem counterintuitive. After all, avoiding unnecessary debt can absolutely be a wise financial decision. But the credit scoring system was never designed to measure every aspect of financial health. It wasn't built to calculate how much you have in your savings account. It doesn't know whether you've invested wisely for the past 10 years. It doesn't know if you own your home outright. And it certainly doesn't measure your financial discipline in every area of life. Instead, it focuses on one narrow question. How have you handled credit when you've had access to it? That may sound like a small difference, but it's the difference that shapes millions of financial decisions across America every single day. And once you understand that, another question naturally follows. If the system is really measuring predictability, then what specific behaviors does it actually reward? The answer is where most people get it wrong, because some of the habits that seem like they should improve your credit can sometimes have little effect, while other habits, ones that look almost insignificant, can quietly influence your score for years. And that's where the real investigation begins. To understand that, you have to stop thinking about your credit score as a grade and start thinking about it as a pattern. Every time you use credit, you're creating another piece of data. Not every action carries the same weight, but together, those actions begin to tell a story. A story about consistency, a story about risk, a story about how predictable your financial behavior has been over time. One of the clearest examples is payment history. It sounds almost too simple. Just pay your bills on time. Most people hear that advice so often that they stop thinking about it. But there's a reason it keeps coming up. Payment history is one of the biggest factors used in many credit scoring models. Think about it from a lender's perspective. If someone has made hundreds of payments over several years without missing one, the history becomes powerful evidence. It doesn't guarantee the future, but it makes the future easier to predict. Now compare that to someone who pays late every few months. Maybe they eventually catch up. Maybe they pay the full balance. But those late payments introduce uncertainty. And uncertainty is exactly what lenders try to avoid. But here's where things become more interesting. Many people believe the goal is to avoid using their credit cards altogether. Ironically, that's not always the most effective approach. Imagine two cardholders. The first keeps a credit card locked away in a drawer. They rarely use it. Month after month, there's almost no activity. The second uses the same card for everyday purchases, groceries, fuel, a streaming subscription, but pays the balance responsibly. Neither person is overspending. Neither is carrying unnecessary debt. The difference is that one person is consistently demonstrating responsible credit management. The other is leaving very little evidence behind. This doesn't mean you should borrow money just to build a credit score. It means the system can only evaluate the information it receives. And that leads to another misunderstanding that costs people far more than they realize. Credit utilization. It's a phrase that sounds technical, but the idea is surprisingly simple. Imagine you have a credit card with a $10,000 limit. If your balance is $500, you're using only a small portion of your available credit. If your balance climbs to $9,500, the picture changes completely. Even if you intend to pay it off next week, a high reported balance may suggest greater financial pressure. What many people don't realize is that your score often reflects what gets reported, not necessarily what happens a few days later. That's why someone who pays their balance in full every month can still see temporary changes in their score if a large balance is reported before the payment is processed. It's one of the reasons timing matters more than many people realize. But this is where another myth begins. Some people hear about utilization and assume the solution is to stop using their cards. Again, that's missing the deeper point. The goal isn't to avoid credit. The goal is to manage it responsibly. Because responsible use creates a long-term pattern. And patterns are exactly what the system is built to recognize. Then there's another factor that surprises many people. Time. In almost every area of modern life, we celebrate speed. Faster internet. Faster deliveries. Faster investments. But credit works differently. Trust inside the credit system is built slowly. A credit account that's been managed responsibly for 10 years tells a very different story than one opened 6 months ago. That's why closing an old account isn't always as straightforward as it seems. Sometimes people cancel their oldest credit card simply because they no longer use it. It feels like cleaning up their finances. In certain situations, that decision may make perfect sense. But in others, it can shorten the average age of their credit history or reduce their available credit, depending on the overall profile. The point isn't that you should never close an account. The point is that every financial decision involves trade-offs. And understanding those trade-offs is far more valuable than following one-size-fits-all advice. By now, a pattern is starting to emerge. The credit score isn't rewarding wealth. It isn't rewarding income. It isn't rewarding intelligence. It's rewarding consistency. Consistency over weeks. Consistency over months. Consistency over years. And that's why two people earning exactly the same salary can end up with completely different borrowing opportunities. Not because one is richer, but because one has built a longer, more predictable financial pattern. But there's still one question left unanswered. If understanding these rules can improve your financial opportunities, why do so many people continue to misunderstand how the system works? The answer has less to do with credit and far more to do with human psychology. The biggest obstacle to building a strong credit score isn't always a lack of money. Very often, it's a misunderstanding. Human beings naturally simplify complex systems. We hear one piece of advice, and we turn it into a universal rule. Debt is bad. Never use a credit card. Pay everything in cash. Those ideas contain some truth. For many people, avoiding unnecessary debt is a smart financial decision. But a credit score isn't designed to judge whether debt is morally good or bad. It's designed to estimate risk. And those are two completely different questions. That's why people who make excellent financial decisions can still have average credit scores. And it's why someone with a high credit score isn't automatically wealthy. A strong credit score doesn't necessarily mean someone has a large savings account. It doesn't mean they're investing consistently. It doesn't mean they're financially independent. It simply means they've demonstrated a history of managing credit in ways that lenders consider predictable. That's an important distinction, because one of the most expensive mistakes people make is confusing a credit score with overall financial health. Imagine someone with an 800 credit score. They qualify for attractive loan offers. They receive premium credit card invitations. Everything looks impressive from the outside. But behind the scenes, they have little savings, no emergency fund, very little invested for retirement. If they lose their income tomorrow, that excellent credit score won't pay the bills. Now imagine someone else. They have a modest credit score, but they've built a 6-month emergency fund. They invest consistently. They avoid unnecessary spending. They're steadily building wealth. Who is actually in the stronger financial position? The answer depends on what you're measuring. If you're measuring borrowing risk, the first person may appear stronger. If you're measuring long-term financial security, the second person may have the advantage. That's why the smartest financial strategy isn't chasing the highest credit score at any cost. It's understanding where a credit score fits within the bigger picture. A good credit score is a tool, just like a savings account is a tool. Just like investing is a tool. Just like insurance is a tool. Each serves a different purpose. Problems begin when we mistake one tool for the entire toolbox. So what does this mean in practice? It means paying your bills consistently, keeping your borrowing manageable, building a long credit history through responsible use, applying for new credit thoughtfully instead of impulsively, and remembering that every financial decision should support your overall goals, not just your score. Because the purpose of good credit isn't to borrow more money. It's to give you better options when borrowing actually makes sense. Whether that's buying a home, financing a reliable vehicle, or qualifying for lower interest rates that reduce the total cost of borrowing. The real advantage isn't access to more debt. It's access to cheaper debt when you genuinely need it. And perhaps that's the biggest misconception of all. Banks don't benefit because you understand the system. They benefit when people misunderstand it. When consumers believe a credit score is the same as financial success, they often focus on the number instead of the habits that create lasting wealth. But lasting wealth has always depended on something deeper. Living below your means, saving consistently, investing for the long term, preparing for unexpected setbacks, making thoughtful decisions year after year. Those habits may not always raise your credit score overnight, but they build something even more valuable: financial resilience. So let's return to the two people we met at the beginning, the one who avoided credit entirely, and the one who used it responsibly. The real lesson was never that one person was smarter than the other. It was that they were being measured by different standards. One was trying to be financially responsible. The other understood how the credit system measured responsibility. The strongest position isn't choosing one approach over the other. It's combining both. Build real wealth outside the credit system. Use credit responsibly within it. When those two strategies work together, your finances become stronger, not because you found a loophole, but because you finally understood the rules. And that's the hidden truth. The credit score loophole isn't a secret banks hope you never discover. It's realizing that the system was never testing whether you were good with money. It was testing whether you were predictable with credit. The moment you understand that difference, you stop trying to beat the system, and you start making the system work for you.